Welcome everyone to today's webinar on what's next for Singapore in 2022. So as 2022 is nearing, one of the top questions investors have is whether the Singapore equity market is still attractive. So at this webinar, we have Ferlin and Hui Shi, who is from our Portfolio Management and Equities team. They will be sharing our outlook on the Singapore market and highlight some opportunities for the road ahead. So they'll highlight particularly on Singapore banks as well as REITs. So now I'll pass the time over to Ferlin.
All right. Hi, everyone. Thanks, Sarah. I'm Ferlin from the research team, and thank you all for joining us tonight. So on tonight's agenda, we'll be sharing a little bit more on the Singapore market and specifically on the Singapore banks and Singapore REITs industry, since these two industries, they make up the lion's share of the STI index. So I will be covering the Singapore banks, whereas my colleague Hui Shi will come in later to talk more about the Singapore REITs outlook before we wrap up this webinar with a quick Q&A session. Okay, so first and foremost, we all know that 2020 was a really bad year for the Singapore banks, but since the late last year, there has been a rotation into cyclical stocks like the Singapore banks. And year to date, the share prices of the three local banks have risen by an average of 19%. And from an earnings perspective, the three local banks have managed to record an average earnings growth of about 40% year on year as of the third quarter results. And this is largely driven by the easing loan loss provisions. And we believe that the earnings growth is expected to moderate given the absence of a low base effect in 2022. But nonetheless, the outlook for Singapore banks remain positive, and we see several exciting trends that investors should look out for. And the first point we would like to discuss more about is the prospect of higher interest rates. So the Federal Reserve has for some time stuck to its the point of how this year's higher inflation as a transitory issue. But after several months of higher prices touching everything from food to energy prices, there is mounting evidence that inflation appears to be sticking around, and this could last well into 2022. And contrary to Chairman Powell claim that the recent high inflation is the result of just a few pockets of inflation, the November's data, which showed a 6.8% annual jump in consumer prices, has exceeded market expectations, which indicates a broadening of inflationary pressures, which previously has been confined to just mostly associated with the economy's reopening, such as aviation and travel. So in light of this situation, we are increasingly convinced that inflation is here to stay, and this could force the Fed to kickstart its rate hike cycle in 2022. And in fact, just last night, it was announced that the Fed is currently projecting 3 rate hikes in 2022 to curb inflation. And since the main interest rate benchmark for the SGD financial markets, SORA, it generally tracks the US Fed fund rate, we do foresee an expansion in the net interest margins of the three local banks when the Fed starts raising rates next year. And given how more than 50% of the bank's revenue still comes from net interest income, we believe that the prospect of higher interest rates in 2022 will be a development that will benefit the Singapore banks. And another factor that investors should look at would be the bank's loan growth. So in the first 9 months of 2021, the three banks managed to record an average loan growth of about 11%, which is a factor that has helped support the bank's net interest income as net interest margins continue to narrow. And loan growth is expected to continue in 2022, which we believe will be derived from sectors like the manufacturing and the property-related sectors. So first, we believe that a strong electronic exports driven by the global demand for semiconductors should continue to feed the expansion of Singapore's manufacturing sector, at least in the first half of 2022. And beyond that, the import demand from the US and China will help to drive export growth in the longer term. So with the manufacturing sector likely to remain as a key growth engine for Singapore, we believe that this will drive loan demand from the manufacturing sector. And on the other hand, as more countries reopen next year, we believe that this could ease supply chain constraints, a challenge that was faced primarily by the building and construction industry this year. So the reopening of borders could result in a smoother flow of labor and raw materials into Singapore, which will lead to a resumption in construction activity next year. And meanwhile, we also expect to see an uptick in mortgage loans across the three banks, given outstanding sales performance in the residential property market in 2021 and the years before. So both trends are expected to lend support to the bank's property-related loans in 2022. However, beyond 2023, the pipeline of housing supply is expected to fall, as shown on the screen here. And as a result, we will likely see a weaker demand for mortgage loans in the longer term. And additionally, just last night, new cooling measures were imposed again, which includes higher ABSD rates, tighter total debt servicing ratio threshold, as well as lower loan-to-value limit for loans from the Housing and Development Board. So this is expected to be another contributor to the sluggish demand for mortgage loans in the longer term. But on a brighter note, we believe that the building and construction loan portfolio of the banks will not be significantly affected by these cooling measures, given that a majority of the construction demand in Singapore is driven by public sector projects. And from a broader perspective, we also observe that over the last couple of months, major Asian countries have seen a surge in vaccination rates, which could support reopening in 2022. So a wave of reopenings and higher international travel, all this will help to support a faster economic rebound in 2022 for the major Asian countries, which are generally tourism dependent. And since loan growth is usually a function of GDP, we believe that there could be potential for further expansion in loan growth, given the bank's presence in Asia, which will in turn boost the overall loan growth for the three Singapore banks. And next, as usual, fee income will remain as a key earnings drivers for the banks. The three local banks' fee income, particularly wealth management fees, will remain a key earnings driver going forward. So in their third quarter 2021 earnings result, the three local banks once again recorded double-digit growth in their fee incomes. So we maintain our stance that the trio is in a good position to capitalize on the fast-growing wealth management space in Asia, and this will be supported by the rising income of the wealthy middle class in this region. And wealth management fee income is likely to sustain its double-digit growth rate in the next couple of years as well, which is in line with the double-digit growth projections made by PwC in its report on Asia-Pacific wealth management industry. So we also believe that the Wealth Management Connect scheme in the Greater Bay Area is an interesting development for the banks. So DBS and OCBC, they have recently, a few months ago, announced that they will be partnering with the local banks in China, which will allow them to provide wealth management services or sell wealth management products to the Chinese citizens. And while there may still be a certain quota, we believe that this scheme, it actually represents an attractive opportunity for the banks to further grow their wealth management business in the longer term. And of course, card fees, which has benefited from the economic rebound this year, we believe that it will sustain its uptrend as consumer spending continues to recover. And card fees is also expected to normalize in 2022. And moving on to our fourth point, having adequate capital is critical to a bank because it ensures that it will have enough cushion to absorb losses and still meet their financial obligation. And as evident in the Singapore Bank's respective third quarter results, they remain to be very well capitalized. So they have also proven to be resilient during the peak of the COVID-19 pandemic last year, despite pressure on asset quality and higher levels of provisions. So I think it's also worth noting that the three Singapore banks, they have passed the additional stress test conducted by MAS in June, where their respective capital positions were projected to remain resilient even under adverse economic scenarios. So therefore, the dividend restriction that was previously set by the MAS has been lifted. And going forward, we also believe that the bank's strong capital position will assure investors that they have the capabilities to maintain sustainable dividend growth. And besides paying out dividends, having excess capital is also important for the banks if they have plans to make acquisitions. And so earlier this year, Citi announced that it has plans to sell its Asian consumer banking business. And at this juncture, it seems that all the three local banks have plans to bid parts of the Citi's loan portfolio. So in general, we believe that such acquisitions could help the Singapore banks to further solidify their position in Asia, and having excess capital will enable them to carry out such deals. And finally, not shown on the screen is some risks that you should take note of as well. Currently, one of the biggest risk factor is none other than the Omicron variant. So while it may be too early to conclude anything due to the lack of data, we do acknowledge that any further spread of the Omicron variant may lead to new social distancing measures being imposed again, which will dampen global growth, which will then inevitably cause a major setback to the global economic recovery. And Singapore's economic recovery will also be delayed, and we might see a surge in loan loss provisions once again, as businesses may not be able to withstand another economic shock. So such developments will cause a dent in both the Singapore bank's earnings and growth prospects next year. And overall, while keeping in mind this potential risk, we remain positive on the Singapore banks. And besides, the Singapore banks were also proven to be resilient during market downturn, and they are also likely to remain so despite potential risk due to Omicron variant. So therefore, we do believe that the Singapore banks are good proxies for further economic recovery in 2022. And based on their fair PB ratios, we can expect an upside potential of about 15% on average. And to sweeten the deal, investors can also expect dividend yield of approximately 5% per annum. And at current valuations, we also believe that OCBC and UOB are more attractive as they have more room for capital appreciation. And that's all I have for the Singapore banks. Now I'll pass my time on to Hui Shi, who will be sharing more on Singapore REITs outlook in 2022.
Thanks, Berlin. Hi, everyone. I'm Hui Shi from the IFAS research team. So today I'll be sharing on the 2022 outlook for the Singapore REITs. Other than the banks, REITs, they are also an important component of the Singapore stock market. And REITs, they are often favored by the local investors for their ability to provide a stream of passive income with the potential for moderate capital appreciation. And their dividend yields are also one of the highest in the region. And now looking back at the performance of S-REITs during this year, the bad news is unfortunately that the S-REITs, they have underperformed the benchmark for the Singapore stock market, which is the STI. So the REITs, as represented by the market cap weighted FTSE ST REIT index, has delivered a total return of only 4.2% year to date. And on the other hand, the STI has delivered a total return of around 13%, largely being led by the Singapore banks. And in terms of valuations, the REIT sector, it is trading at a price to book ratio of 1.09 times. So this is slightly above the 10-year historical average, but it is still below the pre-pandemic levels, suggesting that the recovery is still underway. And the S-REIT sector is very diverse. It is made up of many different types of REITs. And out of all the REITs listed on SGX, we actually found that the industrial REITs, they have delivered the strongest returns on average so far in 2021. And moreover, the successful listing of Digital Core REIT has led the performance of the data center REITs. At the same time, some segments that were hit by the pandemic, such as the office and the retail REITs, they managed to see some recovery. And the only exception was the hospitality REITs, which have continued to underperform the broader sector. So looking ahead, I will be sharing our views on what lies ahead in 2020. So let me start with the industrial REITs. Thanks to structural trends accelerated by the pandemic, industrial REITs, they have generally done well in 2021. And looking ahead into 2022, we expect them to remain resilient. Industrial spaces, they are in demand right now, especially for the new economy industrial spaces, which includes warehouses, high-spec industrial buildings, as well as business parks. The acceleration of e-commerce, as well as the shift from just-in-time to just-in-case inventory management to cope with supply chain disruptions, is expected to drive the demand for warehouses. And meanwhile, the demand for high-spec industrial buildings and also the business parks, they are expected to remain resilient due to the rapid growth of the tech sector, as well as the increase in R&D activities in sectors such as biomedical science. And on the supply side, an additional 3.6 million square meters of industrial space is expected to be completed in Singapore between 2022 and 2024. So this translates into an average annual supply of 1.4 million square meters, which is actually higher than the average of 700,000 square meters over the past 3 years. But if we were to take a closer look, the upcoming supply is not evenly split across the different types of industrial spaces. Most of the upcoming supply, they are actually factories. And on the other hand, warehouses whose demand has boomed will see supply increase by about 600,000 square meters between 2022 to 2024, which is about 16% of the total supply pipeline. And so in other words, the supply of warehouses will increase by approximately 5% during this period. And so in view of the demand and supply dynamics, we think that the rental rates of warehouses should continue to record strong positive growth. And in fact, in the latest quarter, in the third quarter of this year, warehouses rental rates have grown by about 2.6% year on year. And now this table here, it shows the largest industrial REITs by market cap. And with the robust demand for warehouses in recent years, it is no surprise that many of those industrial REITs, they are trading at a PB ratio that is above their 10-year historical average. And over here, one REIT that is worth highlighting is FRASERS Logistics and Commercial Trust, which is the cheapest based on the historical as well as relative standards. It is currently trading at a PB ratio of 1.21 times, which is lower than a historical average, as well as compared to its peers. So FRASERS Logistics and Commercial Trust, or FLCT for short, it is a geographically diversified REIT with about 61% of its portfolio comprised of logistics and industrial buildings. And recently, it has announced the divestment of a non-core property in Port Melbourne. And proceeds raised from this divestment is expected to provide greater financial flexibility for the REIT. And we also note that the REIT is well positioned for inorganic growth. Its gearing ratio is low at 33.7%, which we think provides ample debt headroom to acquire assets from its sponsor's $5 billion pipeline. And overall, FLCT's DPU is estimated to grow steadily at an annual rate between 1% and 4% in the next few years. And in the next financial year, 2023, it is estimated to provide a distribution yield of approximately 5.3%. And we can also see from this chart over here is that FLCT's share price does follow its DPU. And with DPU set to grow over the next few years, we believe that the share price also has room for upside potential. Besides FLCT, another industrial REIT that we think is worth highlighting is ASCENDAS REIT. ASCENDAS, it provides a diversified exposure to industrial assets, including warehouses, business parks, high-spec industrial buildings, as well as data centers. And of which we like the warehouses and data centers, and this make up about 30% of the portfolio. And the remaining 70% of the portfolio comprises of business and industrial spaces, which are expected to remain resilient on the back of demand from the tech as well as the biomedical science sectors. And there's also a $1.8 billion pipeline of assets that can be injected into the REIT. And we believe that acquisitions in the future, they are likely to be made using a mix of debt as well as equity. So AREIT's DPU is estimated to grow at an annual rate of 4% and 6% in the next few years. And at an estimated yield of 5.6%, it is slightly higher than what is being offered by FLCT. And it's also higher, it's the highest out of the large cap industrial REITs as well. And similarly, we think that AREIT's share price also tracks its DPU. And so we believe that in the future, there's also room for upside potential in terms of the share price. And besides the industrial REITs, we think data center REITs, they are also worth considering. Data centers, they have emerged as a bright spot among the real estate asset classes during the pandemic. They stand to benefit from several long-term trends. So this includes an increase in spending on cloud services, emerging technologies such as artificial intelligence, Internet of Things, and 5G, as well as the growth of internet platforms like e-commerce, streaming, and social media. So all these trends, they will increase data traffic, which in turn drives the demand for data centers. And here we have some countries that we deem are attractive data center markets, and Singapore is one of them. The local government has temporarily paused the release of state land for data centers, as well as the development of data centers on existing state land. And we expect such favorable demand and supply dynamics to continue to drive up the rental rates of data centers in Singapore. Other than Singapore, the US, Australia, UK, as well as the Netherlands, they are also attractive markets due to considerations such as cloud availability, fiber connectivity, as well as the size of the market. And last but not least, we think that China also deserves a mention, as it is a market with plenty of growth potential. Its cloud computing industry is still developing rapidly. And as the cloud market expands, we believe that there will be even more opportunities for data center operators. Now, most of you will already be familiar with KEPPEL DC REIT, which is the very first data center REIT that is listed in Singapore. The share price of KEPPEL DC has gone down by about 15% this year, and right now it is trading at a PB of close to 2 times, which is actually a level that was seen only before the pandemic. And we believe the decline in the valuation premium of KEPPEL DC is possibly due to its potential acquisition of M1's network assets, meaning that it will no longer be a pure play data center REIT, as well as increasing competition from the new listing of Digital Core REIT. And in fact, Digital Core REIT, it has had a successful listing. After all, it is being sponsored by a well-known company called Digital Realty, which is the world's largest provider of cloud and carrier-neutral data centers. And with a market cap of about $47 billion US, Digital Realty is also one of the largest US listed REITs. And a potential pipeline of data centers located globally that can be injected into Digital Core REIT stands at about $15 billion US, which actually trumps KEPPEL DC's small $2 billion SGD pipeline. And with a very low gearing ratio of just 27%, we believe that the REIT has a strong ability to acquire more assets to grow its portfolio. And currently, Digital Core REIT trades at a PB ratio of about 1.33 times, which is roughly about a 30% discount to KEPPEL DC's valuations. And while Digital Core offers a lower distribution yield, we believe that it is warranted due to its low gearing ratio, as well as the support from its very strong sponsor. And while we have to acknowledge that KEPPEL DC's valuations is indeed looking more attractive, we still like Digital Core REIT over KEPPEL DC REIT, as we think that Digital Core has more potential for growth. After data centers, the next subsegment that we look at is the office REITs. And following some progress made on the return to office at the start of 2021, the share price of office REITs largely saw a rebound as well. And currently, office demand is mainly driven by the growth sectors such as technology. And we believe that this is likely to continue into 2022. And in the near term, rental rates, they could be supported by a lower level of supply, because in 2022, about 0.8 million square feet of office space is expected to be completed, which is lower than the historical average of 0.9 million square feet. However, we believe that the longer-term outlook for office remains bleak, as there's less certainty, because more office supply is expected to be completed beyond 2022, and at the same time, the increasing adoption of a hybrid work model may result in office space eventually being returned to the market. So this leads to a likelihood of increasing vacancy rates, which could put a downward pressure on rental rates in the longer term. And we find that most office REITs, they also do not offer compelling valuations. So REITs like Mapletree Commercial Trust and KEPPEL REIT, they are trading above their historical averages, suggesting that valuations may be expensive. And they are also offering a yield of around 5%, which is similar to the much more resilient industrial REITs. However, we think that the US office S-REITs, they are worth highlighting for their attractive yields. So this includes Manulife US REIT, Prime US REIT, as well as KEPPEL Pacific Oak US REIT. They are offering a yield of at least 8%. And one of those REIT that I want to highlight over here is KEPPEL Pacific Oak US REIT. While it is trading above its historical average, we believe that it is justified. So for KEPPEL Pacific Oak US REIT, or CORE for short, is focused on the fast-growing tech sector, making it one of the few resilient office REITs. In the tech hubs of Seattle, Austin, and Denver, they contribute about 62% of the portfolios of the REIT's net property income. And in terms of the tenant base, about 43% of the portfolio net leasable area comprises of tenants from the growing and defensive sectors of tech as well as healthcare. And the focus on tech has also translated into a very strong positive rental reversion of 8.1% year to date. And moving forward, we think there are still some opportunities for growth. The REIT has an average built-in rental escalation of 2.6% per annum, and also the current rents are about 7% below the market rents. And overall, the REIT's DPU is estimated to remain relatively stable over the next few years. So this translates into a yield of about 8.1%, which is a lot higher than the average of 5.6% that's being offered by the entire REIT sector. Now, after office, we'll take a look at the retail REITs. So following the relaxation of restrictions, there's been some recovery in the share prices of the retail REITs. However, we observe that the pandemic has changed the way consumers shop. With the acceleration of e-commerce, online retail sales proportion has also climbed throughout the year. And we do note that suburban malls, they are still more resilient due to their focus on the essential goods and services. So for example, in the third quarter of this year, suburban retail rents, they rose by about 0.5% quarter on quarter. And on the other hand, the Orchard Road prime retail rents have declined by about 1% quarter on quarter. And in the near term, we think that retailers, they will continue to face a challenging operating environment as a result of supply chain disruptions. And we also think that the provision of rental rebates is unlikely to go away in 2022, although it could be of a lower quantum. And in terms of valuations, the PB ratio of the retail REITs have remained below historical averages. However, we think that the valuations as well as the yield, they are not compelling when compared to the other subsegments, especially some of the stock picks that I've highlighted earlier. And we also tend to prefer the industrial REITs over the retail REITs, as the industrial REITs are the beneficiaries of the rise of e-commerce. So for instance, there's FLCT is also trading at an attractive valuation. Due to its industrial exposure, we think that FLCT has much stronger fundamentals and is more resilient, which we think makes it a better pick as compared to the retail REITs. And the final subsegment that I'll be sharing today is the hospitality REITs. As the return of international travel was off to a slow start, hospitality REITs, they have underperformed the broader sector yet again in 2021. And the emergence of the Omicron variant has once again served as a reminder to us that the fight against COVID-19 is still far from over. And this time round, travel restrictions have been imposed by governments around the world almost immediately. And while this can help to curb the spread of a new variant, the travel recovery is likely to be delayed. And against this backdrop, we see a lack of near-term catalysts that can drive a re-rating across the hospitality REITs. However, we continue to believe that domestic travel, it will make a faster recovery as compared to international travel. And countries with sizable domestic markets would be resilient amidst the uncertainties. An example of a country with a sizable domestic market is the US. Driven by a recovery of domestic leisure travel, the US hotel market, it has rebounded closer to the pre-COVID levels. And based on the latest data, the revenue per available room, also known as the RevPAR, is only about 8% below pre-pandemic levels. Whereas in Singapore, due to a lack of domestic demand, as well as a slow recovery of international travel, the RevPAR is below pre-pandemic levels by about negative 48%. And this table here, it shows the valuations of the hospitality REITs. And from here, we note that Far East Hospitality Trust, it is trading near historical averages, even though travel is still far from a full recovery. So what this suggests is that its valuations are expensive. On the other hand, there are REITs with a greater focus on domestic travel, and this includes ARA US Hospitality Trust as well as Escort Residence Trust. So for ARA US Hospitality Trust, it holds a portfolio of hotels which mainly serves the US domestic market. And while the US hotel market has rebounded closer to pre-pandemic levels, this REIT has yet to resume distribution payouts. And while it is expected to resume a payout soon, the resumption could be delayed if there's a resurgence in the COVID-19 cases. And for Escort Residence Trust, it has a good exposure to countries with sizable domestic markets like the US and Europe. And its exposure to the long stay properties also offers stability during periods of resurgence. So overall, for the hospitality REITs, the COVID-19 situation still remains very fluid. So there's likely to be some hurdles along the path to recovery. And for investors who wish to invest in them, you should be able to stomach the volatility. Overall, we believe that the uneven recovery of S-REITs will continue into 2022, and distributions of the overall sector is only expected to return back to the pre-pandemic levels in 2023. And the DPU growth will also be varied. We believe that the industrial and the data center REITs, they will continue to generate resilient growth, while the recovery of the reopening plays like hospitality, retail, they will only be gradual. Despite that, we believe that there are still pockets of opportunities within the sector, and we believe that investors should continue to be selective. And generally, we prefer the industrial and the data center REITs as they have stronger fundamentals, which can translate into a sustainable stream of passive income for investors. And our stock picks under these subsegments will be FRASERS Logistics and Commercial Trust, ASCENDAS REIT, and Digital Core REIT. To summarize, we like FLCT due to its strong growth potential and attractive valuation. And we like ASCENDAS REIT due to its large and diversified portfolio of industrial properties and the potential for inorganic growth. And we like Digital Core REIT for its attractive valuation, its sponsor, as well as the huge potential for growth in the longer term. And besides all this, we also like KEPPEL Pacific Oak US REIT for its resilient office portfolio due to its exposure to tech, as well as its attractive distribution yield. And with that, I've come to the end of my sharing on the 2022 outlook for the Singapore REITs. So thank you very much. Now I hand the time over back to our moderator.
Thanks, Wei Shi. I'd like to just share with you about our upcoming 2-day virtual investment and personal finance conference, What and Where to Invest, happening on 8 and 15 January 2022. So at the event, our IFAS and FSM1 research analysts and product specialists from across the region, as well as our product partners, will share about a suite of investing ideas to help you get your investing show right up and running in 2022. And also, we will provide some insight on how you can implement the various ideas shared during the event and tips for your investing journey. So you can also expect to hear from speakers from CSOP Asset Management, Eastspring Investments, Nico Asset Management, Dollars and Cents, The Fifth Person, The Smart Investor, and many more. Registration is free and you can register at our event microsite whatandwhere.fsm1.com. I've also will be placing the link in our Zoom chat function so you can refer to it easily. So with that, we've come to the end of today's webinar. Thank you again and have a great evening.